very good morning and welcome to Market Cafe here on ET Now with me, Lisa Fernandez. And with me, I also have Shreyansi Singh, who's making a debut today on the show. Very good morning and warm welcome to you, Shreyansi.
Morning, Lisa. Thank you.
Well, this is the show where during the course of the next 1 hour, we take the viewers through what's trending both on the international as well as the domestic front. Well, on the domestic front, of course, we will talk about those stocks and those potential buzzers which you have to keep an eye on the back of earnings, brokerages, as well as other updates. But let's get started with what's happening on the international front. Starting with the US market, well, it saw a green on the last day of the month. It was all the indices it traded in green. It witnessed gains. S&P 500, it climbed around 0.6%. Even Nasdaq added points. Dow Jones also advanced around 123 points. And well, the stock futures, they are trading flat with a positive bias, and this is ahead of the Fed outcome which is expected tonight. And talking about we are in the first day of the month, but we see the performance last month in one word, it was dismal. And it was mainly defined by the surging treasury yields. Remember the treasury yield that topped around 5%. It was at a multi-year high since 2007. So if I look at the performance in October, all the three major indices, they posted their third straight month of declines, and it is the longest streak since the first quarter of 2020. Remember, that was when COVID struck in March 2020. So yes, Dow as well as S&P 500, they all declined around 2%. Even Nasdaq, it declined to more than 2.8% in October. And what led the losses in October was the energy sector, and utilities was the only positive sector in the S&P 500. So that's largely what came in from the US handover. And also the October consumer confidence that came in at higher than expected at around 102.6. The employment cost index that rose around 1.1% in Q3, which was again more than expected. So yes, all eyes will definitely be on the Fed rate outcome, which is expected today on the back of the elevated treasury yields, which is still at around 4.9% as we speak now. Talking about the European market, even European stocks, they logged their worst month, and that is since September 2022. And though it saw gains on the last day, but then it didn't, rub off on the whole of the month. The Eurozone inflation that fell to a two-year low of around 2.9% in October, but it was lower than estimates. So that's largely what's coming in from the US as well as European markets, Shreyansi. But what's happening on the crude as well as other commodities?
Well, Lisa, it does look like that the Wall Street is looking a little bit resilient at this point, but can't say the same about oil prices, because oil prices eased as markets worried less about potential supply disruptions from the Middle East conflict. Now, in fact, data showed rising output from OPEC as well as the United States. That being said, trading was largely choppy, with prices up as much as $1 higher during the session, but prices were around that $90 a barrel mark. But what are the key events that you're looking at, Lisa?
Right, so as I mentioned earlier, the FOMC rate decision will be a big event to keep an eye on, and also the commentary that is coming in from the chair, Powell. But are the other cues that we have to look out for are the October auto sales data, the PMI data, India fiscal deficit as well, and earnings are also in focus with Sun Pharma, Hero Motor, Tata Steel, as well as Britannia. They will be reporting their earnings today, Shreyansi.
Right, thanks. So let's switch our focus back to global news now. When you look at the Palestinian death toll, that has crossed 8,500, and in the history of the most heinous attacks since October 7th, humanitarians denounced Israel's attack on the Jabalia refugee camp, saying that this deadly attack should be a wake-up call to the world leaders to secure a ceasefire in Gaza. A nearby hospital says at least 50 people were killed in the attack. Meanwhile, the armed wing of the Palestinian group Hamas has said that it will release some foreign captives from Gaza in the coming days. Now, dozens of injured Palestinians will be allowed to exit the bombarded zone from the Rafah crossing to seek treatment in Egyptian hospitals. Palestinian Health Ministry has also issued final warnings around hospitals running out of fuel and power generators.
And US President Joe Biden as well as Chinese President will be meeting on the sidelines of the Asia-Pacific Economic Cooperation Summit in San Francisco. And it still remains to be known what is the agenda of this upcoming meeting.
And shifting focus to central bank activity this week, the Japanese central bank has allowed more flexibility in its yield curve control policy. Now, the Bank of Japan effectively widened its yield target band by 50 basis points to 1% on either side. It also increased the country's inflation outlook, citing rise in import prices and recent crude spike.
And Softbank-backed WeWork, they plan to file for bankruptcy as early as next week. And the news is coming amidst the company's struggles with a huge debt pile as well as a hefty losses in the quarter gone by. Well, the shares of the company that slid around 32% in the after-hours trade.
When you look at AMD, that reported a beat in their Q3 earnings. Now, the chip maker issued a weaker than expected forecast, said it expects $6.1 billion in sales in the fourth quarter. In an Nvidia-dominated market, you have AMD that has said its chips are on track for volume production in the current quarter.
And Berkshire Hathaway has sold Hong Kong-listed shares of electric vehicle maker BYD for around $25.78 million. And this is coming after the dip in the electric car sales as well as warnings by several automakers as well as suppliers. Because the major economies, including China as well as Europe, they are seeing weaker growth in the EV segment.
Well, with this, let's slip into a short break. See you on the other side.
Welcome back to the show, and we are on that part of the show where we track and mark the Asian markets. So let's see what the Asian markets are doing now. As I can see on the screen, it's a sea of green. It seems that the global market, that rally has rubbed off on the Asian market as well. Nikkei, of course, it's up around 2%, and that is because Bank of Japan has kept their rates steady. And also moving on to Kospi, that is around 0.9%. HSI index, that is around that is trading flat but with a positive bias. Shanghai is also around 0.6%. Well, talking about Kospi, the exports data has come out, and as per the October exports data, that has climbed 5.1% on year-on-year basis, and that is the first time in the last 13 months. So that's why we can see Kospi also shining. ASX is also 0.4% up in trade today. But we can see Nikkei, it's shining amongst all the Asian market indices. It's up around 2%, and also the FOMC rate decision also it's weighing on the indices as well, and that is why we can see good gains coming in. Talking about the GIFT Nifty, it's up around, it's trading flat. It's at around 0.2% at Nifty closed at around 19,089 level, and we can see GIFT Nifty, it's at around 19,136. So slight bit of a gap up opening for the Indian market is expected today. So let's see how it pans out for the Indian market today. Welcome back to the show, and we are on that part of the show where we talk about what's trending in the domestic front and also the stocks that we have to keep a watch on. Well, in the first half of FY24, India's fiscal deficit that reached rupees 7 lakh crore, accounting for 39% of the annual estimate. And the government, they are aiming to maintain a fiscal deficit of 6.4%, targeting rupees 17.8 lakh crore for the entire financial year. Now, the tax revenue that stands at around 11.6 lakh crore, and that represents around 49.8% of the annual target, while the total expenditure that is at around 21.2 lakh crore, which is 47% of the budget estimates for 2024.
And when you look at India's 8 core sectors, they experienced a cooling growth in September, hitting a 4-month low at 8.1%. Now, this decline was driven by reduced expansion in the cement industry, follows August's 14-month high of 12.1% that was attributed to a favorable base effect. When you look at the dip in the core sector growth, notably in crucial areas like crude oil production, may signal a potential decrease in the index of industrial production or the IIP data for September, with implications for India's overall industrial growth.
Well, and yesterday L&T came out with a strong set of numbers for the second quarter. And if we look at anyway, it was expected that L&T will come out with good set of numbers, but it actually beat estimates by a good number. The company reported around, or if I talk about the revenue, that was up around 19%, and EBITDA that was up around 15% on year-on-year basis. Margin also that saw a slight bit of contraction, but it was quite slight at around 42 bips contraction which was seen. Revenue was in line. EBITDA, PAT, EBITDA came 4% above what was estimated from the street, while PAT that was at around 13% more than what the street estimated. Now, talking about the margin, which saw contraction, the management said that it's mainly because of the business mix, because of the low margin infra that was higher in their order book, as well as the legacy projects that's now actually coming to an end. So that actually weighed on the margin, but it's still quite stable compared to last year. International revenue growth was higher than the domestic revenue growth. The domestic growth that came at around 15%. And if I talk about even the order inflow, that was at around 89,000 crore. Mainly, we can attribute that to the Saudi Aramco orders, which was more than 30,000 crore, which they booked last quarter. So even the order inflow growth, that also came higher than what was anticipated. So all in all, it was a good set of numbers. Now, talking about the guidance, management said that they will be outperforming the guidance that they had given earlier. And on the guidance, order inflow that stands at around 10 to 12%, and revenue growth that stands at around 12 to 15%, which they had given earlier. But they said that they will be outperforming this guidance. So, but on the core margin, guidance, which they had given at 9% earlier, they are saying that it will be at around 8.5% to 9%. So largely, it's the same. So all in all, good set of numbers, and even the management highlighted that the orders coming in from Middle East regions, considering the geopolitical tensions and all, they remain optimistic about the orders going forward in GCC region. So that's largely what was the earnings around L&T. So good set of numbers coming in from L&T and positive reaction expected.
Well, so a good show for L&T, Lisa, but the same can be said about mid and small caps. Now, a recent Kotak report has highlighted 3 factors which have led to outperformance in certain mid and small cap stocks. According to the report, improved fundamentals along with strong narrative and low free float drive are the key drivers behind this rally in mid and small cap stocks. Ashesha is standing by with more details of this report. Ashesha, what are you picking up?
Well, yes, Kotak has done some interesting analysis on the recent outperformance that we have seen in the small and mid-cap stocks. And they've given clear 3 reasons of why mid-caps and small caps have outperformed the broader markets in the recent past. One of them being improved fundamentals in some cases, strong narratives in many other cases, and possible low free float in some other cases. So let's analyze each of these 3 points separately. First up, they say that strong narratives translating into higher delivery in these small and mid-cap stocks. And they also say that they are attributing the sharp increase in delivery volumes to increasing expectations of strong returns from these small and mid-cap stocks. Secondly, they've also spoken about low free float stocks, and these stocks have outperformed in the recent past. They say analysis of performance of small and mid-cap stocks suggests that many outperforming companies actually have lower free float as compared to underperforming companies, especially in the small and mid-cap space. They say this is not the first time that they've observed this trend. They observed this trend in 2017 as well, where a mid-cap rally was seen in 2017, where a number of mid-cap stocks actually delivered phenomenal returns, and similar trend is reshaping yet again in 2023 as well. Stocks with lower free float outperformed their peers back then in 2017. Now, what is the way ahead? They've also spoken about that, where they say that market expectations around returns of most of these companies reflect a great deal of optimism, especially at a time when stock returns have outperformed improvement in fundamentals. And they say that fundamentals need to improve so that the rally in small and mid caps can actually sustain. So yes, very interesting analysis, and what is the way ahead for most of these small and mid cap companies.
Well, thank you for that, Shirsha. So, free float is leading to the rally in mid and small caps. But JSW Energy also will be in focus today because the joint MD as well as the CEO, Prashant Jain, he is set to resign from his position, and that is effective from 31st Jan next year. Now, with this resignation, he will also cease to be the director of the company. And in the statement, the company cited personal reasons for an early retirement. The company, it saw a 25% jump in its revenue and also 2 times growth in its net income during Jain's 6-year tenure. Let's look at further details with coming in from Anisha Jain. She is here on the phone to tell us more about this development. Anisha?
Yes, this news is not coming in as a complete surprise because speculation was right for the last couple of weeks that this might happen. And along with earnings, the company had appointed a chief operating officer as well. So that gives you the hint that perhaps they are preparing the second line of leadership as well. Having said that, Prashant Jain was very instrumental in the company's transition because we have seen the biggest transition in the energy sector in perhaps last 5 decades, within the last 5 years itself. And Prashant Jain was leading it from the front. A lot of new initiatives have been taken in by the company, right from pumped storage to green hydrogen, and it will be very critical for whoever takes charge to make sure that the execution is done well. You already pointed it out, but he was appointed back in 2017. And since then, the stock has given a return of almost 5.5x. That turns out to be a compounded rate of almost 33%. The profits haven't jumped up that much, but the profitability has more than doubled. More interestingly, he was, of course, associated with the JSW Group for 28 years. So he was a through-and-through JSW Group person who knew the insides as to how it works. And for the new person, that also will be important. He's going to be there till January 2024. There is 3 or 4 months for transition. But the big question Street will be asking is, who will now take up the CEO's role? For now, the analysts that I've spoken to are not talking about any major downgrades. But my guess is there would be a bit of selling pressure on the stock tomorrow.
Well, thanks, Anisha, for more details on that change of guard at JSW Energy. But let's switch focus to SBI Card, and that in collaboration with Reliance Retail has launched a credit card called the Reliance SBI Card. Now, this will provide a rewarding shopping experience and offer benefits as well. Now, my colleague Ankur Mishra caught up with Abhijit Chakravarti, who's the MD and CEO of SBI Card. Let's listen in to a slice of that conversation.
From Q1 to Q2, our credit cost has come down. So, which indicates somewhere the delinquencies are getting controlled. Somewhere, as we have gone on record saying that the overall unsecured loan portfolio in the ecosystem, somewhere there is a stress on that is being reported across the domain. We are not untouched out of that, and we do see some stress in some accounts, not exactly in any cohorts, and we have taken steps to control them. However, any step taken will take time to evolve. Like whatever step we took in portfolio level earlier, they have given us good results. So these account level interventions will keep on continuing, and in the short run during the Q3 we do see the credit cost prevailing, moving around the existing levels. And we will see how our efforts come out in the post Q3.
Last question regarding, you mentioned about the profit part. I mean, that you want the journey to continue. What are the steps taken on that front? We understand the stress part, as you mentioned that, it is going to continue for some time. But how are you going to increase your profits?
See, profit is a function of cards being issued and spends being made. Look at those numbers. My card numbers have gone up. My spends have gone up exponentially. Year on year, it has gone up by 22%. So, if my spends are going up, I am adding new cards, then only thing that can add is the margin.
So, margins are going to be better, you are saying?
Margins will be there. Let's wait and see how it turns out.
And it's the 1st of November, that time of the month when automakers are reporting their monthly dispatch figures. And will it be a better month on the back of festive demand? Srishti is here joining in with what to expect. Srishti, what do you expect from all the segments, PV, CV? How are they expected to perform?
Well, Well, yes, October was quite an interesting month for the auto sales data because in the first half of October month, we had the inauspicious period called Shraddh, and then in the second half, we had Navratri and Dussehra picking up, and the sales driving the numbers this time around, wherein festive sales expected to get the cheer back in the two-wheeler segment specifically, as well as passenger vehicle expected to hold that momentum steady, while in the entry level, we have seen the discounts inching up. Firstly, let's talk about the two-wheeler segment then, because we are expecting the return of the entry-level customers this time around. At least this is what dealers are indicating. And all in all, we are expecting a single-digit growth for all the companies right there on a month-on-month basis, from the likes of Hero MotoCorp, Bajaj Auto, TVS Motors, iShares. They are all expected to deliver a single-digit growth on a month-on-month basis. But yearly, if we see, then Hero MotoCorp as well as TVS Motors are expected to show a double-digit growth. Dealers are definitely indicating that there could be a return of the entry-level customers during Navratri. Let's wait by and see that what the numbers are coming in from the retail front. But the inventory build-up is happening from the likes of Hero MotoCorp, which is expecting a robust festive sales this time. Coming to the passenger vehicle segment then, herein M&M, Tata Motors as well as Maruti Suzuki, we are expecting a single-digit growth on a month-on-month basis. The SUVs continue to surpass the record sales data. Other than that, the discounts in the entry-level segment is inching up, and that's why for Maruti Suzuki, what dealers are indicating that the inventory build-up is happening quite at a healthy pace. From the commercial vehicle segment, because September was quite a strong month for all these commercial vehicle companies. So on the back of that, if we compare the numbers on a monthly basis, then yes, there could be a decline in single digit, but on a YOY basis, Tata Motors and Ashok Leyland are expected to show a double-digit growth. For Ashok Leyland specifically, 70,500 is the number what we are expecting, because do remember, for the past 2 to 3 months, Ashok Leyland has been really surprising onto the number front. And lastly, from the tractor division, not much of a commentary from that front, because I believe that the cheer is all about the two-wheeler and passenger vehicle this time around. But the rural sentiment does hold strong, though the festive season retails were quite muted is what the dealers were indicating, and almost a flattish sort of a growth for M&M tractors is what we are expecting. A number close to 45,000 is our expectation, and from the Escorts we are expecting 12,800 units onto the sales data. So let's wait by how the companies panned out and how much festive cheer we get to see for October sales data.
Well, thanks, Srishti. So waiting by to see festive cheer in Motown. But with this, we're timed out on this segment. See you on the other side. Back. Thank you so much for staying tuned in. Let's look at the stocks that we're looking at. Now, we're looking at Nuvoco Vistas. That had a revenue of about 2,573, which was an uptake of about 3.2% year on year. Now, when you look at the profit after tax for that one, it was about 1.53 crores versus a loss of 130 crore on a year-on-year basis. EBITDA also came in with an uptake of about 72% year-on-year. And when you look at the margins, they were at 12.8% versus 8% year-on-year. Now, Max Financials had a consolidated profit after tax of 170.3 versus 61.6 year-on-year, and a revenue from operations coming in at 101.6 crores versus 93.2 crores year-on-year. When you look at MRPL, we also had revenue from ops that was at 22,843 crores, and which comes in at a downtick of about 20%, interestingly. So you do have the profit of tax that also came in at about 1,051.7 versus 1,779. Now, when you look at the EBITDA profit, that came in at about 2,138 versus an EBITDA loss of 1,994. When you look at DCB Bank, that also had an uptick in the profit after tax that came in at about 126.8, and the PPOP came in at about 210.5 versus 182.6 on a year-on-year basis, also an uptick of about 15%. When you look at provisions, they were at 39.7 versus 31 crores on a year-on-year basis. GNPA also came in at 3.36 versus 3.26 on a quarterly basis. And when you look at NNPAs, they also came in at about 1.28 versus 1.19. When you look at Keynes Technology, that had a revenue from operations that was at 360.8 crores versus 273.1 crores, which is an uptick of about 32%. When you look at the profit profit after tax that also had an uptick of about 54% and came in at 32.3 crores. Now, when you look at Mankind Pharma, that also had revenue from operations that came in at about 2,708, which was an uptick of about 7% in the revenue. When you look at the profit after tax, that also had an uptick of about 19%. And when you look at the EBITDA, that also had an uptick of about 16%. When you look at the margins lastly, they also came in at about 25.2% versus 24.3% on a year-on-year basis. But Lisa, what are you looking at when you look at Bharti Airtel?
Well, yes, Bharti Airtel, they reported a mild miss in their Q2 numbers, and profits were actually lower on account of an exceptional loss of around 1,500 odd crore. So let's go across to Somit for the fine print of the numbers.
Well, Bharti Airtel's second quarter numbers were a slight miss compared to what the street was expecting, largely on the EBITDA front. Now, revenues have come in 1% lower compared to last quarter. EBITDA came in at close to 19,500 odd crore rupees on a consolidated basis. Margins stood at close to around 52.7 odd percent. Now, when it comes to the India mobile business, revenues and EBITDA both were up 3 odd percent. ARPU came in 1.5% higher compared to last quarter, around 403 rupees per user per month. Now, on consolidated basis, the numbers are a slight miss because of a weak performance coming in from the Africa business. But on the India mobile business front, the numbers are pretty much in line with what the street was expecting. Now, whatever growth we are seeing on the India mobile business is purely in the back of a higher subscriber base and higher ARPU. Subscriber base, in fact, has grown for the 7th consecutive quarter for Airtel, and rising data consumption on the network also indicates that strong 5G subscriber adoption has been seen on Airtel's network. And that is the key reason why the ARPU of the company has also grown above their medium target. When it comes to the other business segment, that is broadband, DTH and enterprise, they grew pretty much in line with what the street was expecting. And when compared with its peers also like Reliance Jio and Vodafone Idea, Airtel India's mobile performance has been pretty much in line and very much comparable with what Reliance Jio reported, and in fact on the better side when compared to Vodafone Idea.
Well, thanks, Amit. We'll definitely be keeping an eye on Bharti Airtel. But sticking with earnings for now, Tata Steel is also all set to report its Q2 numbers. And my colleague Ashesha is standing by with more details. Ashesha?
Well, yes, Tata Steel is expected to report weak set of numbers among peers, and this will be led by drag on Tata Steel Europe operations. Tata Steel Europe is expected to report a loss on EBITDA per ton level for the 4th consecutive quarter, and we are expecting Tata Steel Europe's EBITDA per ton to come in at negative $120 per ton versus negative $96 that the company had reported in the previous quarter. As far as numbers are concerned, consolidated revenues could come in at 55,200 crores, down 7% sequentially, while margins could come in at 8.9% versus 8.7% that the company had reported in the first quarter. As I mentioned, Europe continues to be a pain point for the company, and EBITDA per ton is expected to decline on account of lower volumes and lower realization, which will be partially offset by lower input costs in the quarter gone by. Remember, steel prices in European region declined by about 7 to 8% sequentially, and hence your realizations are expected to be impacted. As far as India operations are concerned, demand continues to remain very strong. Raw material prices were on the lower side. Both coking coal and iron ore prices were on the lower side. Remember, in the quarter gone by, company also unveiled its restructuring initiative as far as its UK operations are concerned. So any commentary from the management with respect to its UK operations and commentary on debt and capex plans will also be keenly awaited.
Well, thank you for that, Ashesha. But Hero MotoCorp is all set to post its Q2 earnings, and while the revenue as well as net profit, they are expected to rise on a year-on-year basis, all eyes will be on the demand outlook as well as the product launch timeline. And Srishti, who tracks it closely, is here to tell us what to expect from the company.
Well, yes, on the margin front, we can expect so, because from 13.8% in Q1 FY24 EBITDA margin, we are expecting it to go higher to 14.1% this time around, because do remember the volumes were actually flat on a YY basis, but seen a jump of 4.7% on a quarter-on-quarter basis. The company has been taking the price hikes, their premium motorcycles from the likes of Harley getting good order booking is what they have highlighted. And all in all, the exports have also seen a jump of almost 50% on on a quarter-on-quarter basis, but export doesn't form that big a part for Hero MotoCorp. Talking of numbers, then we are expecting a revenue jump of 5% at 9,209 crores is our expectation for the top line. The margins expected to improve to 14.1% this time. Let's wait and watch that if there could be any surprise on that front or not. But on to the profit figure, we are expecting that to be almost flat at 983 crores, but EBITDA could see a jump of 8% on a quarter-on-quarter basis. The EBITDA margin expansion will definitely be on the back of the better realizations, the volume-led growth, as well as the average selling price has seen a jump of 3% YOY basis. But going ahead, what's their demand outlook? What's their festive season sales outlook, as well as booking number for Harleys, if they share any? That will be the key to watch.
Well, thanks, Srishti, but stay with us for now because pharma giant Sun Pharma is also all set to report its Q2 earnings, and as per estimates, margins are likely to contract. So give us more details about that one.
Firstly, let's talk about Sun Pharma earnings. We are not expecting any great set this time around because the US sales is expected to show a decline of 2% on a sequential basis in constant currency terms, while the India business is expected to be supported. A 7 to 10% jump on a YOY basis is what we are expecting on that front, basically on the back of the price hikes of the drugs that the company has taken. All in all, if we talk about, then a sequential decline of 2% onto the bottom line of the company is what we are expecting. 2,298 crores is the expectation. Talking about their top line, just a 1.5% growth on a sequential basis is what we are expecting. 12,118 crores is the number. And also onto the margin figure, from 27.9% in Q1 FY24, we are expecting it to decline to 26.8% this time, while the EBITDA is expected to be flat. But all in all, if we see that why the pressure could be in their US sales, then GREV limit sales is not expected to be that supportive this time, though their specialty sales, drug sales continue to do well from the likes of Sequa as well as Illumia. So both of these drugs expected to support the earnings for the US markets, but GREV limit is something that could put some pressure. But the guidance that the company has given for FY24, whether they retain or do any sort of an upgrade or downgrade, that will be the key to watch. And what is their outlook on the US market specifically going ahead? We will be watching out for that as well.
Well, we'll definitely keep a watch on Sun Pharma. It is expected to report their earnings. But moving on to FMCG major, Britannia is also set to declare their Q2 numbers today. And the top line as well as the bottom line, they are expected to rise on an annualized basis. Now, what is the street penciling in, and what will be the key factors to keep a watch out for when it comes to the management commentary? Vinny is joining us with more details on this. Vinny?
Absolutely. So in terms of Britannia's numbers, we're not expecting that great set of numbers coming in from Britannia this time around. Revenue growth expected at just around 4%. Profits, we're expecting the growth that could be at around 9%. While in terms of margins, an expansion coming in of around 110 basis point. EBITDA margins expected at 17.4%. Now, volume growth expected at 3%, so that's quite muted. And similar trends we have seen coming in across FMCG companies. What is an important factor is that local players are now coming in, regional players are coming in, so the competition in biscuits is expected to be higher there as well, and that is why revenue is expected to be somewhere around 4%, and that is what is keeping the volumes in check as well at around 3% as well. Obviously, gross margins expected to see an improvement because of the premiumization trends coming in terms of correction in raw material prices, and EBITDA margins obviously is being supported by that. But moderate expansion is what we're expecting in EBITDA margins this time around because of the lower benefit that is actually coming in from the raw material cost. So 110 basis point expansion in terms of the margins of the company. Factors to watch out for: what is the commentary coming in terms of the competition from regional players, outlook for the pricing as well as margin outlook, commodity prices as well as the margin outlook, demand trends across geographies, rural area, how is that recovering, key factor to watch out for as well, and commentary in terms of new launches. Let's not forget, in the recent couple of days as well, we've seen last couple of days that Nuvama came out with a note on Britannia where they downgraded the stock actually to a hold. In the near term, they see no triggers, meaningful triggers for the company. That's why they gave a target price of 4,350 rupees per share. So let's keep an eye out on Britannia's earnings and how they perform in trade.
Well, thanks, Vinny, but stay with us for now. Tata Consumer Products also reported a healthy set of earnings in the quarter gone by. In fact, when you look at their top as well as bottom line, they were in line with street expectations. So help us put this into perspective.
Absolutely. So in terms of Tata Consumers numbers, when you look at it, a decent number that came in from the company, revenue margin and profits were in line with the estimates. Volume growth, that's where, the positive came in, because the salt volume growth grew by 6%, as well as in terms of when you look at the India beverages business, that saw a volume growth of 3%. That's the tea business saw a volume growth of 3% as well. So that's a positive sign coming in over there. The beverage business grew by further 8%, while India food business grew by 16% as well. Overall, the companies managed to see a growth of 11%, profits saw a growth of around 3.4%, and all in all, margins have also seen an expansion, 14.3% versus 12.9%. So good expansion in terms of the margins of the company. The company highlighted that the premium brands was something that was supporting the growth of the company more than the mass brands or the economic brands. Premium brands is something that outperformed for the company. One factor to watch out for is that the market share that one saw in tea, value-wise as well as in salt, we have seen a decline coming in that front. So that's a factor to watch out for as well, where in terms of the tea market share in terms of value as well as tea salt market share in terms of value is what saw a decline. But overall, the outlook the company is seeing this year, stable demand environment, cautious outlook, and cautiously optimistic in terms of outlook going forward. Branded tea business and coffee business was something that faced a bit of a headwind in terms of the international market, and the company highlighted that they expect to complete the Tata Coffee merger by this financial year. So let's keep an eye out on that.
We'll definitely keep an eye on Tata Consumer. Thank you for sharing the numbers with us, Vinny. But shifting focus on Navin Fluorine, they reported their earnings, unlike all other most of the chemical companies that reported weak earnings. Even Navin Fluorine also reported weak set of numbers. If I look at the revenue on year-on-year basis, on a quarter on sequential basis, it was down around 4%. Even the margin, that saw a contraction of around 20% versus 23% that we saw last quarter. The numbers came well below the estimates. And talking about the earning snapshot, the weak quarter was mainly affected by the slow ramp up of the HPP plants, slower stabilization of R32 project, the deferred revenue in specialty as well as the CDMO project that also weighed on the earnings. But they are positive about their capex plans going forward. Remember, Welling, he had resigned, and there was some pressure on the stock because he was a driving force behind most of the capex. But the management has not hinted at a slowdown in their capex plans, but they have not given a timeline as such on their approved fundraise, what they are going to do going forward, and no firm timelines given on that. And the management also said that strong order, the order book that looks quite strong across all the business segments, and the lost revenue that is expected to be recouped partially in Q3. So specialty revenue that is expected to see volume growth in Q3, and that will be mainly driven by the new products, and they also expect scale up in the MPP project in the coming quarters. Well, they also added that the agri molecule project that will start in H2 FY24. So they have given an update on that plant as well, and the CDMO deferred sales that will be realized in Q3. So that's on Navin Fluorine, expected to see some pressure today on the back of its weak set of numbers. Triyansi.
Well, thanks, Lisa. That's about Navin Fluorine, but let's also shift our focus back to the markets, and market veterans Ravi Dharamshi, Nilesh Shah, as well as Pankaj Tibrewal talk about sectors to keep an eye out for, especially over a long term. Listen in.
Financials, manufacturing, energy transition are three themes which we believe have a strong tailwind, and they fall in the bucket of where the outlook remains strong. And financials, in fact, falls in the bucket of where the valuations also from a historical perspective remain very attractive. For manufacturing and capital goods, probably that's not the case. Some of the growth is already factored in, but the tailwinds are strong enough for us to say that any kind of a correction, serious correction, would be an opportunity to buy.
We have been liking names around capital goods, around defense, around auto components, the tier 2 banks, very specialized players in the financial space, which is online broking, online insurance. These are the kind of businesses that we have been owning. Also, our exposure to alcoholic beverages, we think that's a standout sector from a 5 to 10 year perspective.
Which will cover different parts, which is capital goods, cement, chemicals, and so on and so forth. Pipes, which is another core part of the infrastructure. Last but not the least, incrementally, we believe that the earnings downgrade cycle in IT could be behind us, and we believe FY25 could be far better than FY24, and we are looking at opportunities in the IT space incrementally as well.
And that's all the time that we had on this edition of Market Cafe, but stay tuned as we catch all the action on the market. For now, it's a thank you and a goodbye from me as well as Shreyansi.